Major Wall Street indices correct over 1% on fresh rate hike fears as retail sales remain stronger than anticipated. Banking stocks come under pressure as Fitch warns of a possible rating downgrade for dozens of banks. Asian markets also edge lower as Chinese economic data disappoints. The GIFT Nifty too implies a lower start for the Indian market after the Independence Day holiday. Inflation in July accelerates to its highest level in 15 months. Soaring vegetable prices take the consumer price index to 7.44%, well above the RBI's target band. Core inflation, however, remains below 5%. ITC delivers strong results in the first quarter. Cigarette volume growth comes in higher than estimates, while FMCG sales cross 5,000 crore rupees. Net profit too surpasses expectations. The board has also approved the demerger of the hotel business. Sources say the Gangwal family will sell up to 4% stake in Interglobe Aviation in a block deal worth 3,700 crore rupees. The family's stake will fall to a little under 26% post the deal. The remaining stake, worth over 25,000 crore rupees, will have a lock-in for 150 days. And in other news, SEBI bars Puneet Goenka from taking up the position of managing director in the Zee Entertainment Sony merged entity. Reports also suggest that Zee promoters Subhash Chandra and Puneet Goenka will appeal against the verdict. Infosys bags a mega 1.5 billion euro deal with existing client Liberty Gold to provide AI solutions while Vodafone Idea's losses expand. The company has also availed a 30-day grace period to pay back 1,680 crore rupees worth spectrum dues. Meanwhile, M&M outlines its strategy for electric vehicle and farm sector vehicles, launches a new brand identity for electric vehicles, also targets the market for lightweight tractors with the launch of the Ola electric range. Good morning in the Mumbai News Center. I'm Sonal Bhutra and you're watching Power Breakfast. Those are the top headlines, a lot to catch up on. But of course, the big global news is that we saw a sharp fall in the US markets. There are fears of rate cuts when it comes to US banking stocks as well. And that is something which put some pressure on the US indices as well. Let's take a look at what the impact on Asian markets has been. And we did get a slew of macro data as well coming in from China that disappointed. And on the back of that, there is red across the Asian screen. We have Hang Seng sitting with cuts of 1.1%. The Taiwanese index is lower by 0.4%. And that is the case in the other markets as well. We have something like a Taiwanese index which is lower. Nikkei is down 1%. Kospi is seeing cuts of 1%. And if we look at the GIFT Nifty, because we'll see and compare it with Nifty futures, this one is indicating that the start for our own markets could be in the red. 76 points lower is what the implied open is suggesting as we speak. So watch out for that one as well, below that 19,400 mark right now. Staying with Asia, the Chinese central bank unexpectedly cut a key policy rate for the second time in 3 months on Tuesday as the country's economic rebound took a hit. China's July industrial output and retail sales also missed expectations. CNBC's Eunice Yoon gets us a roundup from Beijing.
The central bank move was quite a bit of a surprise. The central bank had reduced the one-year medium-term lending facility by a bigger than normal margin of 15 basis points. In addition to that, the bank cut the 7-day reverse repo rate, and this is a key rate that helps to guide short-term liquidity for banks. At the same time, of course, we got this terrible economic data, very downbeat for July. The retail sales really stood out. They rose by 2.5%, but that compares to the year when a lot of people were under lockdown. So that gives you a sense of how bad the retail numbers were. Factory output missed. FAI, or fixed asset investment, missed. Private investment shrank by 0.5%. Real estate investment, a huge driver for this economy, also sank down by 8.5%. Urban unemployment worsened. The government now says that they are suspending reporting this data as of August. They say that they need to change the methodology because they said that the current methodology wasn't really reflecting what's happening in the economy.
Okay, all right, that's the update coming in from China. Let's get you some more global cues, and it's weak coming in from the US ahead of today's session. Wall Street ended Tuesday's trading session lower with all three major averages. The Dow Jones, the S&P 500 and the Nasdaq closing with over 1% cut. Shares of big banks like JP Morgan Chase, Bank of America, Wells Fargo tumbled after Fitch warned it may have to downgrade the credit rating of dozens of banks. Shares of regional banks were also under pressure after the Fed President Neel Kashkari's remarks in favor of further capital regulation. Retail sales growth for the month of July came in at 0.7%, higher than the expected 0.4% increase. In fact, on that note, let's listen into some important opinion coming in from former Kansas Fed President Esther George.
The consumer, as we see today in retail sales, so important to this economy, and they really have hung in there despite what has been one of the most aggressive tightening cycles that the Fed has undertaken. So this is an extraordinary time. We're watching these imbalances in the economy continue to work their way through. Some sectors not doing as well, others like the consumer really powering ahead. It's not just the Fitch downgrade. I think if you look at what the Congressional Budget Office itself put in a report this summer, we're not on a good path in terms of our fiscal situation. And so it will be important, certainly for the long term. But I think even now, watching how interest expense on government debt is growing, very important that this aspect of policy be addressed. And that, of course, separate from what the Fed is doing, but equally important, I think, to our future.
Okay, that is the global market action. We do not have positive cues coming in there. A lot of action, especially on the macro front. But how will these overnight cues impact our own markets? We have our research team joining in to tell you just that. The trade setup, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, very good morning to all of you. Rima, let me come across to you first up. What is the market setup looking like today?
Well, it's definitely going to be a down opening, right? The GIFT Nifty, as you pointed out, is currently lower by about 75, 80 odd points. The key level to track will be about 19,250. If you remember, in Monday's trade, the Nifty went down all the way to the 19,257 mark before it rebounded to close above 19,400. So Monday's intraday low of 19,257, which also now coincides with the 50-day moving average, will be a key support level for our markets to hold on to. The global picture is weak. U.S. markets ended with a cut of more than 1%. The dollar index is building on above 103 levels, and the money markets is shut today. But if you see, the other Asian currencies are weakening in trade. The worry is, as Fitch pointed out, that they may downgrade U.S. banks, including the large JP Morgan. The reaction to the surprise rate cut by China, which is far lower, higher than what the street was anticipating. If you remember, the PBOC, People's Bank of China, has cut rates by 15 basis points. In the past, it's always resorted to about a 10 basis points cut. So the rate cut by China has been more than what the street was anticipating, given their weak economic data. But the market reaction is grim. They want more. So it's not that, the Chinese, the investors there believe that this is going to be enough to get them out of that funk. For our own markets, the July CPI inflation is a big shocker, coming in at 7.4%, and we'll discuss this more. But Citi has pushed the first rate cut expectations from the Reserve Bank of India to June of 2024 versus their earlier call of April 2024. Back to our own markets, one more word. There is a clear, dichotomy in way banks are underperforming and the way IT has stepped up and has started outperforming. The month-to-date, performance of the sectoral indices will be up for you on your screen. Back to you.
All right. Okay. Thank you so much for all those cues, Rima. Let's talk about all the cues from the F&O space. Mangalam is joining us with that. Hey, Mangalam.
Good morning. So, on Monday, we did see that stellar recovery that happened from the lows of trade, and the indices closed near the day's high. And that was largely on account of a couple of large caps doing well. The large heavyweights like Reliance, L&T, we saw gains coming in on names like Infosys as well as HUL too. However, it could have been technical in terms of a bounce. The reason why I say that is because the Nifty day's low on Monday was 19,258 and the 50-day moving average was the same. The Nifty Bank as well bounced back from the 100-day moving average of 43,571, went closer to that, and from there we did see a bounce. At no point in that bounce did we see the markets actually go off to the races and get out of danger. Why do I say that? Because one, the FI has continued to write in cash markets. They've sold around 2,300 odd crores, and the Nifty August futures premium compressed from 76 points to around 44 points. And even as the market was moving higher, the India VIX, the volatility index, was moving higher as well. That was telling you that there were adverse positions being added on the index futures side as well. The FI has continued to sell 440 crore worth selling there, and now the short exposure is at 61 odd %. Even in index options, yes, there was some unwinding of calls, but at the same time, we saw only 22,000 puts being written. So that's telling you that there might not be a big support or at lower levels itself. What is the range that the option writers are playing for? 19,400 call writers, extremely active for a premium of 100 rupees, telling you levels upwards of 19,500 will face resistance. And on the lower side, 19,300 and 19,350 put writers are active as well. So the range of the day should come up for you on the screen. In terms of stocks, just watching out for a couple of levels. Just GNFC has entered FNO ban and Hindustan Copper has exited FNO ban.
Okay, all right. Those are all the cues from the FNO space. But now over to Abhishek, who will list out the stocks to watch out for in today's trading session.
Well, to begin with M&M, they have launched 7 lightweight 4WD tractors. Infosys, Liberty Global and Infosys have expanded their strategic collaboration to bring AI-powered digital entertainment to customers. This is about $1.6 billion. GMR, the board has approved fundraising of up to Rs 5,000 crore via QIP. ITC, the board has approved demerger of hotel business. Vodafone Idea, in terms of the Q1 performance, the net loss has widened both YOY and quarter-on-quarter. Even the margins have declined when compared to both YOY and quarter-on-quarter. So they have written to Telecom Department as well with respect to spectrum auction due payment. They will pay about 1,680 crores of spectrum auction due for August 17, 2023 by availing a 30 days grace period. And when they avail this grace period, they'll pay it along with the interest as well. Indigo Gangwal family to sell shares worth up to 3,735 crores via block deal today. This is the third tranche of selling by Gangwal family in the recent times. So VIP Industries, they have appointed MD and CFO of the company. Penar Industries, they get order worth about 702 crore across various business verticals. And Z has SEBI order come in, which means that SEBI has barred Goenka and Subhash Chandra from holding any key managerial position in Z Group, holding any key managerial personnel in demerged entities as well, and taking managing director position in Z Entertainment Sony merged entity. Back to you.
Okay, all right. Thank you so much, guys, for joining us and prepping us up for this trading day ahead. Time for a short break now. When we return, inflation in July accelerates to its highest level in 15 months. We'll get you more on that on the other side. Welcome back. You're still watching Power Breakfast on CNBC TV 18. Well, the big news that we got on Monday, it is an important macro data. India's July inflation came in far higher than expected at 7.44%, led largely by 11.5% rise in vegetable prices. Let me go across to Lata because it has come in as a shocker. Lata, your take?
Well, this 7.44 against a poll of about 6.6% was a shocker. Largely food-led. Food was up 11.5% compared to about 4.8% in the previous month. Now, within food, vegetables rose 38% year on year, month on month from June to July. And even if you take the 7.4% versus 4.8 in June, the 2.6 percentage point increase, 2.3 percentage points were accounted for by vegetables. The worrying part is not vegetables because they will recede. It is also cereals. Both cereals and pulses are up 13% year on year. That sticks. Now, what's the positive? Core inflation. Core inflation came down to 4.9, and that's very important because that contributes to the receding factor. The economist response is that, of course, Q2 forecasts have risen July, August, September from earlier about 6.2. Everyone is taking it up to about 6.8. But the full year inflation also has been raised now arithmetically from about 5.4 that the Reserve Bank forecasts to about 5.6 to 5.7. Impact, no one expects the Reserve Bank to hike just yet, even if it is discussed and debated, because, vegetables are transient and could come down. The important part is that the rate cut gets pushed now. Probably, people were expecting April next year. Now it goes to June or August. Immediate impact, bank stocks will take a knock. Anything interest rate sensitive will have to take a knock. Even maybe realty stocks will take a knock today. There will be a big knock on rupee and bonds, but that we will know tomorrow. Markets close today.
Okay, all right. So it is going to be a weak start for our own markets, courtesy the CPI print that we got for the month of July. But with that, we'll move on and talk about micros now and focus on some important earnings. ITC will be the stock in focus today on the back of its first quarter earnings. Manglam is here to take us through the numbers. Manglam?
Well, for ITC, the first quarter numbers, there were strong internals that the company reported. In fact, that's one. The second thing is that the hotel swap ratio was announced. The stock has corrected about 10% from its recent all-time high, and as a result of which we may see some bounce back. Let's talk about what was good. Cigarette revenue growth of 13%, led by volume growth of 9 to 10%. The street was working with a growth of 7 to 8% itself, so that's a positive. The FMCG business crossed 5,000 crores in revenue for the first time in a quarter, so that's positive, along with margin expansion. Overall margins at nearly 40% came in higher than street expectations of about 37%. And as a result of which, the net profit, which was 4,900 crores, was above street expectations of 4,800 crores as well. What were the other segments like? The hotel business, that grew 8% on a high base. The margins out there too came at around 22%. Paper revenue declined by about 6.5%. That's because of low paper prices and high base, high raw material prices as well. And agri revenue was down 24% on account of wheat export ban. If you adjust for that, the agri revenue was up 31%. Those were the strong internals and some problems which a couple of their segments faced. Hotels demerger, we saw the company announce a swap ratio of 1 hotel share for every 10 shares of ITC, and they said that the hotels business should list in about 15 odd months. So put all these things together, yes, on an optical basis, the revenue was below street expectations, the EBITDA was higher, as were the margins, and was the net profit. See some green on the stock today.
Okay, see some green on ITC stock today. Thank you, Manglam, for that take. Moving on to the other big name, the Mahindra Group has outlined its strategy for electric vehicles in farm sector. They have also launched Oja, a new platform intended for the lightweight tractors. While the new Oja range of tractors are set to hit the market in October, the 5-door electric Thar is expected to launch after 2027. My colleague Parikshit Luthra is here with more details on this one. Parikshit?
Here in Cape Town, the Mahindra Group has outlined its future strategy for electric vehicles and the farm equipment sector. Starting with electric vehicles. Now, this is a time when electric car sales are picking up and they could cross the 1 lakh mark. Mahindra has only one electric SUV in the market right now. Next year will be the E8, which will hit the markets in December 2024. What they have done, they have unveiled a new brand identity for electric vehicles, an Infinity Loop logo, which will be carried by all future electric vehicles, including Born Electric and ICE vehicles, which are converted into electric in future. This is to differentiate the EV portfolio from the ICE portfolio, which will continue to carry the Twin Peaks logo. They've also showcased a production-ready BE05 electric SUV to show that they are ready with an electric SUV for the market. Behind me is an electric Thar, a 5-door electric Thar, which could come to markets after 2027. This is also an indicator of the 5-door ICE version of the Thar, which will hit the markets next fiscal. The company has also showcased the Oja range of tractors. Now, these are ICE tractors exclusively in the farm segment, And this will be important for the Mahindra Group because these are lightweight tractors that have been launched to target farmers in the horticulture sector, orchard farming, those with smaller land parcels, not just in India, but in ASEAN and US. And the company believes that this will be important for driving their market share, driving the next phase of growth in the tractor segment.
Okay, all right. Pariksha, thank you so much for bringing us all those details. With that, we'll slip into another break. Up next, we'll get you all the cues from the commodities market. Stay tuned for that. Welcome back. You're watching Power Breakfast on CNBC TV 18. We spoke about a lot of macro cues, micros as well. It's time to talk about commodities. Manisha Gupta is joining us with all the update. Hey, Manisha, good morning.
Morning, and thank you so much for that. I'll start with the crude oil prices, where we have seen the prices decline almost by 2% overnight. So from near 87.5, we're just about holding $85 a barrel right now. Well, the prices did gain 20% in the past 7 weeks, and that is because of the OPEC and Russia output cut. But what the markets are looking at right now is the weak China data, whether it has been about the retail sales, industrial production, fixed asset investment. All of those numbers have come in on the weaker side. And then the street is also looking at the U.S. crude inventories. That data comes today in the evening. But the metals have had no better luck. Gold and silver prices are trading at a 5-month lows. The strength in U.S. dollar, higher treasury yield, weak China data, strong U.S. retail sales numbers, all of that seems to be weighing on across metals as a sector.
Okay, all right. So that's the update coming in from the commodity space, the metals and the crude segment in focus. And, you know, with crude prices rising over the past couple of months, last night it did see some profit taking. But because of the rise that we saw, the government has also raised windfall gains tax. The tax on crude petroleum, that has been increased to 7,100 rupees a ton from 4,250 rupees a ton. The special additional excise duty on diesel has been raised to 5.5 rupees a litre from 1 rupee a litre earlier. The duty on aviation fuel has been set at 2 rupees a litre versus nil earlier, while the duty on petrol, that continues to be nil. On the back of this, a lot of stocks that will be in focus as well today. Actually, with that, we'll take your leave on this edition of Power Breakfast. Stay tuned. Bazaar Morning Call comes up next.